Welcome to Bitscreener. This video presents shooting star candlestick patterns and how does it work in trading. Definition: a shooting star candlestick pattern is a popular charting technique used in trading. It is a single candle, a bearish reversal pattern which is formed after advancement in price. The shooting star candlestick pattern indicates the market turning from bullish to bearish trend. Features: a small body candle. The long upper shadow must be at least 2 or 3 times the length of the candlestick. Little to no lower shadow. The body can be both green and red. It appears at the top of an uptrend, having at least 3 bullish candles before shooting star. When does the shooting star appear? When the market opens, the buyers attempt to push prices higher. However, the sellers will react to create a huge selling pressure to push it down. In other words, it occurs when an asset's market price is pushed up quite significantly, but then rejected and closed near the opening price. Distinguish the shooting star and the inverted hammer. Both shooting star and inverted hammer have a longer upper shadow and a small body. However, they appear in different situations. The inverted hammer refers to a bullish reversal and often appears at the bottom of the downtrend, while shooting star relates to a bearish reversal. How to trade. Traders should take some notices below into consideration while trading. There need to be at least 3 consecutive bullish candles before a shooting star candle. Wait for the confirmation of the market. When the next candle closes, place a buy order. Place a stop-loss order above the top of the shooting star. Combine with other technical analysis such as RSI or resistance line. The shooting star candlestick should never be viewed in isolation. Thanks for watching. Don't forget to like, share and subscribe to our channel for updated videos every week.